What if I told you that the single family home in Long Beach is selling for 106.7% of its asking price right now? That's not a typo. While the headlines are screaming about a slowdown, the data on the ground shows that sellers of single family homes are, on average, walking away with nearly 7% more than what they listed it for. This isn't what you're hearing on the national news, is it? It's why, if you're thinking about buying or selling in Long Beach, you need more than headlines. You need a strategy. My name is Israel Hernandez, and if you're looking for that kind of clarity, the first step is a simple conversation. All my contact information is right down there in the description below. Let's talk. Today, we are going to bust the biggest myth in Southern California real estate. The idea of a single monolithic housing market. Because right now, the Long Beach market isn't one story. It's a tale of two entirely different worlds moving in opposite directions. And understanding which world you're operating in will be the single biggest factor in your success. Whether you're buying your first condo or selling a family home you've owned for decades. Imagine this for a moment. You're a buyer and you've just found the perfect home in Los Altos in the 90815 zip code. It's got the schools you want, the tree-lined streets, the whole package. You walk in and you know it's the one. The problem? So do 5 other families. The data shows that a typical home in this neighborhood is going under contract in just 11 days. The inventory here is critically low at just 1.4 months of supply. This isn't a theoretical exercise. This is the reality for buyers in our city's most competitive pockets. It's a pressure cooker. But then, just a few miles away, a different story is unfolding. A buyer is looking at the stylish condo in Belmont Heights in the 90814 zip code. They've been watching it for a while. In fact, the data shows the median property here sits on the market for 114 days. That's nearly 4 months. This buyer isn't in a pressure cooker. They're in the driver's seat. They have time, they have options, and they have negotiating power. 2 buyers, 1 city, 2 completely different realities. So what's causing this great divide? To understand what's happening on our streets, we first have to look up at the big picture, the national forces that are pulling the levers on our local market. The most important player on this stage is, of course, the Federal Reserve. And the big news is that they've been finally pivoted. On September 17th, the Fed cut its key interest rate for the first time since 2024, trimming it by 25 basis points. This was a direct response to a cooling national economy and a softening labor market. The Fed's own projections, the famous dot plot, signal that more cuts are likely on the way before the end of the year. This is the signal that the era of aggressive rate hikes is over, and the immediate effect that everyone cares about is on mortgage rates. As of this week, the average 30-year fixed mortgage is hovering in the 6.3 to 6.4% range. Now, while that's a huge improvement from the 7+% rates we saw earlier this year, it's also a critical reminder that the Fed doesn't directly set mortgage rates. They've ticked up just a bit recently, proving they have a life of their own. But let's translate this into real dollars. The drop from over 7% to the mid 6% range isn't trivial. For a buyer, this can easily save hundreds of dollars on your monthly payment and add tens of thousands of dollars back into your purchasing power. It's a tangible relief. However, and this is the multi-billion-dollar however, this relief for buyers has not solved the market's single biggest problem, a severe lack of homes for sale. And the reason for that can be summed up in 2 words: the lock-in effect. This is the most powerful force in California real estate today. An estimated 81% of California homeowners have a mortgage with an interest rate below 5%. Think about that. If you're a homeowner with a mortgage at 3.5%, what financial incentive do you have to sell your home, give up that incredible loan, and buy a new one with a mortgage rate at 6.4%? The math is brutal. For many, it would mean doubling their monthly payment just to make a lateral move. This is why our inventory is so tight. It's not that people don't want to move, it's that it's financially punishing to do so. My analysis shows that we need to see mortgage rates dip below the 6% threshold for a sustained period to begin meaningfully loosening the grip on this lock-in effect. Until then, any new wave of buyer demand from these lower rates will crash against the same wall of limited supply. And there's one more macro level ingredient stirring the pot: the job market. The latest national employment report for September was a surprise, showing a net loss of 32,000 private sector jobs. This cooling of the labor market directly impacts buyer psychology. Where there's even a hint of uncertainty about the economy, people become more cautious about making the biggest financial commitment of their life. This isn't a sign of panic, but it is a sign of prudence. Buyers are taking a little bit more time, doing a little bit more homework, and that caution is contributing to the rebalancing we see in certain parts of the market. If wading through dot plots and labor reports feels overwhelming, you're not alone. My job is to connect these global trends to your front door. If you're looking for a partner who can translate this complex data into a clear, actionable strategy for your family, my contact information is in the description below. Let's have that no pressure chat. Now, let's bring it back home to Long Beach and dissect this tale of two markets. The data from September paints a picture of a sharp, undeniable bifurcation between single-family homes and the condo market. First, let's talk about the single-family home market. To put it plainly, it remains a robust, competitive seller's market. The months of supply of inventory, which measures how long it would take to sell all available homes, is a razor-thin 2.12 months. For context, a balanced market is considered to be 5 to 6 months of supply. We are nowhere near close. This scarcity is fueling intense competition, with 135 single-family homes sold just last month. This is why we see the staggering 106.7% average sold to list price ratio I mentioned earlier. The typical single family home isn't just selling at its asking price, it's selling in a bidding war that pushes the final price nearly 7% higher. And it's happening fast. The median time on market is just 19 days. This fierce competition has pushed the median sold price to $970,000, a 1.5 jump in just the last month, with the median price per square foot hitting $719. For sellers, this is fantastic news, but it also signals that we are bumping up against an affordability ceiling. A market can't sustain this level of aggressive overbidding forever, and I expect we'll see price growth begin to level off and stabilize at these new, higher plateaus in the coming months. Now let's pivot to the condo and townhouse market. It's a completely different universe. Here, the story is one of rebalancing, normalization, and opportunity. The inventory level is nearly double that of single-family homes, standing at a much healthier 3.92 months of supply. This is still technically a seller's market, but it is rapidly approaching balance. And you can see the effect that it has on negotiations. The average sold to list price ratio for condos is 99.6%. This is a critical data point. It means that the days of automatic bidding wars for condos are largely over. Buyers are successfully negotiating at or even slightly below the asking price. The power dynamic has shifted. The median price per square foot here is $552, offering a much different value proposition. With more inventory and less urgency, condos are taking longer to sell. The median time on market is 36 days, almost twice as long as a single family home. This gives buyers what they haven't had in years: breathing room, time to think, time to inspect, and time to make a confident decision. Historically, the condo market often acts as a leading indicator, a canary in the coal mine for the broader market. The rebalancing we're seeing here could very well foreshadow a similar, though more muted stabilization for the single-family home market 6 to 9 months down the line. But the story gets even more interesting when we zoom in, because Long Beach isn't just one market, it's a mosaic of unique neighborhoods. Let's start with the 90815 zip code, Los Altos and Plaza area. As I mentioned, this is the epicenter of demand. With just 1.43 months of supply, it is the tightest single-family home market we've analyzed. Homes here with a median price of $1,147,500 sell in a median of 11 days with a 100.7% sold-to-list ratio, confirming most get multiple offers. The heat from this market is so intense that it creates a spillover effect, keeping the local condo market with a median price of $540,000, much more competitive than the city's average. Now travel over to the 90814 zip code, which includes Belmont Heights and Park Estates. This neighborhood presents the most dramatic contrast. The high-end single-family market here is incredibly strong, with a median price soaring to $1,830,000 based on a tiny sample size of just 3 very fast sales. But the condo market, it is without question the single biggest zone of opportunity for buyers in Long Beach today. Inventory has risen and the median time on market has ballooned to 114 days. Let me repeat that. 114 days. The sold to list ratio is 98.2% and the median price is in excess of $445,000. The message here is crystal clear. Inventory is stale, sellers are motivated, and buyers have tremendous leverage. Then you have 90807, which includes Bixby Knolls and Cow Heights. It's a strong seller's market for houses with a median price of $1,275,000 and a 101.1% sold to list ratio. We did see an odd data point here. A 292% month-over-month jump in days on market to 51 days. But with only 2.19 months of supply, this is likely an anomaly caused by a few outlier sales. The real story here is in the condo market, which flashed a fascinating signal. A massive 175% month-over-month jump in the number of new listings in September. This sudden influx of inventory could quickly shift the dynamic in favor of buyers. It's a micro market we are watching very, very closely. Finally, there's the affluent coastal enclave of 90803, Naples and Belmont Shore. Here, the location is so powerful that it makes the area an exception to the rules. The condo market here is nearly as competitive as any single-family market, with a median price of $750,000, just 2.19 months of supply, and a 101.6% sold to list ratio. It's a testament to the timeless, unshakable value of living by the water. Which of these neighborhood dynamics surprised you the most? The 114 days on market in Belmont Heights, or the surge in new listings in Bixby Knolls? Drop a comment below and let me know your thoughts. Beyond today's transactions, a smart strategy always looks to the future. And the future of Long Beach is being built right now. The city is in the middle of a major development boom focused on creating a more vibrant, dense, and connected urban core. Downtown and the shoreline are being transformed. We have multiple large-scale projects underway that will add hundreds of new, amenity-rich rental units to the market. This is part of the city's long-range downtown shoreline vision plan, an ambitious effort to enhance walkability, create new public spaces, and remake our waterfront. For anyone living or owning downtown, this revitalization is a massive long-term value driver. However, this new supply of high-end rentals creates a new competitive dynamic. If you own an older condo downtown that you use as a rental property, you're about to have a lot more competition. This is a significant long-term risk to consider. But for an owner-occupant, the new restaurants, shops, and improved public spaces are a pure, undeniable win. This growth isn't just happening downtown. Major corridors like Studebaker Road and Artesia Boulevard are receiving tens of millions of dollars in infrastructure investment, creating complete streets that are safer, more beautiful, and more valuable. This is the kind of smart growth that supports long-term property values for everyone. So what does all of this mean for you? How do you take this mountain of data and turn it into a winning game plan? Let's break it down into clear, actionable recommendations. First, for you, the home buyer. Your strategy must be tailored to your target. If you are aiming for a single-family home in a competitive area like Los Altos or Bixby Knolls, you must be prepared for battle. But you must fight smart. This means getting your financing fully underwritten before you even start looking. It means being ready to act decisively. But in this cooling economy, it does not mean taking foolish risks. I am strongly advising my clients against waiving the inspection contingency. Your best strategic advantage is to target properties that have been on the market for more than 14 days. In a market this fast, 2 weeks can be an eternity, and it often signals a seller who is ready to negotiate. If you are looking for a condo, your strategy is to hunt for value in plain sight. The data is screaming to that 90814 zip code as your primary opportunity zone. Target properties that have been on the market for over 60 days. Go in with a confident but reasonable offer below the asking price and use the market data, the 114 days on market and 98.2% sell to list ratio as your justification. This is where you can negotiate seller credits to buy down your interest rate or for closing costs. You are in a position of power. Now for you, the current homeowner. If you are thinking of selling, your strategy is simple. Price to the minute, not to the moon. The single biggest mistake a seller can make right now is overpricing their home. The era of testing the market is over. My analysis is unequivocal. Homes priced correctly from day one are the ones generating multiple offers and selling for a premium. Overpriced homes are sitting, accumulating stigma, and ultimately selling for less after a price cut. And if you're one of the millions of homeowners with a low rate mortgage, you're facing the lock-in dilemma. The decision to move is now a profound financial calculation. Before you even think about listing, you must sit down and quantify the staggering cost of giving up your 3.5% loan for a 6.4% loan. For many, the smarter financial move might be to stay put and invest in your current home. A renovation or even adding an ADU could unlock the lifestyle you want without sacrificing the loan that you have. The bottom line is this: the Long Beach real estate market is more complex, more nuanced, and more divided than it has been in years. But complexity does not mean impossibility. It means that strategy, data, and expert guidance matter more now than ever. There is incredible opportunity out there for buyers who know where to look and for sellers who know how to position themselves correctly. This is the kind of in-depth analysis I provide for every single one of my clients. If you're ready to move beyond the headlines and build a real strategy tailored to your specific goals, all of my contact information is waiting for you in the description below. Let's have that no pressure conversation. Thank you for spending this time with me today. If you found this analysis valuable, please hit that like button, subscribe for more updates, and share this video with anyone you know who is trying to make sense of this shifting market. I'm Israel Hernandez, and I look forward to helping you navigate your next move.